What if I told you that one number quietly controls the financial life of millions of Americans? It affects your mortgage, your car payment, your credit card, your student loans, your rent, your savings, and even the stock market. That number is the interest rate. Most people ignore it because it sounds boring. But when interest rates rise, life becomes more expensive. Not all at once. Slowly, quietly, painfully. A house becomes harder to buy. A car becomes harder to finance. Debt becomes harder to escape. Businesses slow down. Jobs become less secure. And suddenly, the entire economy feels heavier. Welcome to Next Gen Finance, where we break down money, business, and the economy in the simplest way possible. Today, we're explaining why interest rates are crushing Americans. This is not just a banking topic. This is about everyday life. It is about why borrowing money costs more, why homes feel unaffordable, why credit card debt feels impossible, and why one financial decision can affect millions of households. Interest rates are basically the price of borrowing money. When rates are low, borrowing becomes cheaper. People buy homes, businesses expand, consumers spend more, and the economy moves faster. But when rates are high, borrowing becomes expensive. People hesitate. Businesses slow hiring, home buyers step back. Debt becomes painful. Spending becomes weaker. That is why interest rates matter so much. They do not just affect Wall Street. They affect normal people sitting at kitchen tables trying to pay bills. The biggest place people feel interest rates is housing. A house may already be expensive, but the interest rate decides the monthly payment. Two people can buy the same house at different times and pay completely different amounts every month. Why? Because one got a lower mortgage rate and the other got a higher one. That higher rate can add hundreds or even thousands of dollars to monthly payments. So when people say homes are unaffordable, it is not only because prices are high, it is also because interest rates made the payment too heavy. This is why many buyers feel locked out. The house is listed for sale, but the monthly payment says no. Interest rates also affect car loans. In America, many people need cars to live. They need cars for work, groceries, school, family, and daily life. But when rates rise, car loans become more expensive. That means higher monthly payments. And when you add insurance, gas, repairs, and maintenance, the cost becomes painful. Many people are not just paying for transportation. They are paying for access to their job. That is serious financial pressure, and high interest rates make it worse. Credit cards become even more dangerous when rates are high. A person may think, I'll pay it off later. But later becomes expensive. Interest grows, minimum payments feel endless, balances barely move, and the debt becomes harder to escape. This is why high interest rates punish people who already carry debt. The system becomes heavier for those who are already struggling. They are not only paying for what they bought, they are paying for the cost of borrowing. Interest rates also affect businesses. When borrowing becomes expensive, businesses think twice before expanding. They delay new projects, they cut costs, they hire fewer workers, some may even lay people off. This affects the job market. And once workers feel insecure, they spend less. Then businesses earn less. Then the economy slows further. That is how interest rates move through the system. Well, one decision affects loans. Loans affect spending. Spending affects businesses. Businesses affect jobs. Jobs affect families. Families affect the entire economy. Interest rates often rise because policymakers are trying to fight inflation. When prices rise too fast, higher rates are used to slow spending. If people borrow less and spend less, demand cools down, and prices may stop rising as quickly. But this creates a difficult trade-off. Fighting inflation can make life more expensive in the short term. People may get relief from rising prices slowly, but they immediately feel pain through loans, mortgages, and credit cards. That is why interest rates are so controversial. They may help control inflation, but they can crush household budgets. High interest rates affect people differently. For savers, higher rates can be helpful. Savings accounts and money market funds may pay more, but for borrowers, high rates are painful. Mortgages cost more. Credit cards cost more. Car loans cost more. Business loans cost more. So the impact depends on your financial position. If you have cash, high rates can benefit you. If you have debt, high rates can hurt you. This is why wealthy people often survive high-rate environments better. They have assets and savings. But people living paycheck to paycheck feel the pressure immediately. Interest rates may sound boring, but they are one of the most powerful forces in your financial life. They decide how expensive debt becomes, how affordable homes feel, how businesses grow, how markets move, and how much pressure families feel every month. The lesson is simple. When rates are high, debt becomes dangerous. Cash becomes valuable. Financial discipline becomes more important than ever. So if you want to survive a high interest rate economy, control debt, build savings, avoid unnecessary loans, and understand that the price of money affects everything. If this video opened your eyes, subscribe to Next Gen Finance for more videos about money, business, and the economy. And remember, interest rates do not just move markets, they move lives.